Hello again. If you've been following our series on the lessons to learn from market history, you'll know that one of them is to avoid trying to time the market. In part 4, we gave the example of the brilliant economist John Maynard Keynes. He thought he could work out when markets were about to rise and fall, but came to realise that even he couldn't manage it. Now, 2 British academics have published a paper on this very subject. Professor Elroy Dimson on the left of the picture and Dr. David Chambers on the right are from Cambridge Judge Business School.
Keynes actually went through a very steep learning curve in terms of his investment activities. He, as well as investing for himself, he invested for a number of institutions. In particular, however, he looked after the money of his college, King's College here in Cambridge, where he ran that particular fund from the early 1920s up until his death in 1946. The fascinating thing is that Keynes started off believing that it was possible for him to time when to put money into stocks, take it out of cash or take it out of bonds, put it into stocks, and then take it out again when he thought the market had reached a peak. He, despite being, one would think, well positioned to execute a strategy like that, because he was already a preeminent economist, he was one of the founders of the leading economic statistical service in this country, the London and Cambridge Economic Service. So he was looking at all this data related to the economy and industry and the stock market. Notwithstanding those advantages, he was unable to spot the fall in the market in London that came in the autumn of 1929, and he had committed his portfolio in quite a significant way to investing in stocks. So that was a very painful experience for him. And what our research has shown, that during the course of the subsequent years in the early 1930s, he did actually significantly change the way that he approached investment, and he moved to what we would call today a bottom-up approach, which was a much more patient, long-term approach, a buy-and-hold approach we call it today. Subsequently, in the later 1930s, in 1937 to 38, when the London market experienced another significant fall, he didn't worry too much about trying to time getting in and out of shares. He just stuck with those stocks that he really liked. So that was an extremely radical change, and I think it illustrates that market timing does remain an extremely difficult thing to do.
So, if not even Keynes could time the market, it stands to reason that for the amateur investor it's all but impossible. We should also treat with scepticism the claims of so-called experts that they have the knowledge and skill to get in and out of the market at just the right time. Here's Professor Dimson.
Any investor that has the choice should always go for having very good foresight, because hindsight is misleading. So when we look back in time, we can always see when shares looked expensive and we should have got out, or when shares looked cheap and we should have got in. But at any particular point in the past, we only have data which is available at that time. And that makes it much more difficult to determine when's a good time to invest and when is a bad time to invest. So the mantra that people share is the importance of time in the market rather than timing the market. Time in the market enables you to take a long-term perspective and to reap rewards if you are in there long enough. Timing the market means you may avoid the bad times, but you may actually just get out of an asset class just when it's about to do well.
Thank you to Professor Dimson and Dr. Chambers for that insight. And if you haven't seen our market history series, you can find it on the Sensible Investing TV website or on our YouTube channel. Goodbye.